Good evening, friends. Today we have a second day on special Ind AS series. We have TC Bafnaji, our senior member, our guide. We have today's faculty, CA Manoj Sahu ji. We have our co-organizer, C. Abhishek Shah, committee member of Navi Mumbai branch as well. Would like to request TC Bafnaji to introduce Manoj Sahu ji and start the session. Bafnaji, please.
Okay, now again, most welcome CA Manoj Sahu ji and the viewers of today's professional platform on this special session of accounting standard. As you know, this Mr. Sahu is the chartered accountant of 2008 and having very vast experience in the statutory audit and statutory compliances, and he is a co-opted member of the WRC committee also. And he's taken various lectures on this accounting standard, Companies Act, GSTs, IFRS, and this valuation, and this concurrent audit and all, etc. He having some vast experience on this accounting standards and the Companies Act. So the viewers can take the benefit of this vast experience, eminent personalities, Mr. Manoj Sahu. So welcome, Mr. Manoj Sahu. And with this, our organizer, Abhishek Shah and the Virag Shah on this session. Most welcome, Mr. Manoj Sahu and the viewers. Thank you.
Now I would like to request Abhishek Shah to address the attendees.
Good evening, friends. So welcome CM Manoj Sahu sir and Bafnaji. So regarding our upcoming webinars, just wanted to highlight tomorrow we are having special 2 webinars. One is for spiritual by Guruma, and one is by one of the MD director on recent impact of COVID on financial statements. And we are having also 2 web series. One is on Companies Act and one is on IBPC. So I request all the members to please join, or also please share with your friends and colleagues, those who are interested to join our webinars. Thank you. Now I request Manoj to start the session.
Thank you all. Yeah, thank you all. Friends, today we will deal with the 2 standards, that is Ind AS 2 and Ind AS 16. Ind AS 2 relates to the inventories and Ind AS 16 relates to the property, plant and equipment. First, let us discuss the Ind AS 2. Ind AS 2 specifies the recognition, measurement and disclosure criteria with respect to the inventories. And after this COVID-19 pandemic, the most debate was made on the inventories for the purpose of audit of the financial statements. But I think we need not to worry about this inventory parts for the purpose of this audit of the financial statements. As you go back and rethink that the lockdown was called on from 23rd March, which was just ending of this our financial year. And in this financial year, only 8 days was left out. So the movement of inventories were not there, as the operation also not there from any of the industries, except some essentials commodities. And friends, other auditing standard also prescribes that when an auditor cannot perform the routine procedures, the standard allows to perform the alternate audit procedures. What this alternate audit procedure for the inventories, we will see in the coming slides. Let's start our discussion on the Ind AS 2. Ind AS 2, the objective of the standard is to prescribe the accounting treatment for the inventories. The primary issue in the accounting for the inventory is the cost that could be recognized for the inventories and how it can be carried forward until the related revenue is not recognized for the same. The standard also provides the determination of the cost of the inventories and its subsequent recognition as an expense, also written down to net realizable value. It also provides guidance on the cost formulas that needs to be used while assigning the cost to the inventories. What cost formula needs to be applied for each class of the inventories that the standard is prescribing. What does the standard covers? What is its scope? Standard applies to all the types of inventories, except two exceptions are provided by the standards. First one is the financial instruments, which deals by the Ind AS 32 and Ind AS 109. And second one is the biological assets related to the agriculture activities. This there is a separate standard for this also, Ind AS 41, which deals with the biological assets. And one more thing, that the cost incurred to fulfill the contract, cost which is incurred to fulfill the contract with the customer and that do not give rise to the inventories, is also dealt with and to be recognized as per the accounting treatment prescribed under Ind AS 115, revenue from the customers, revenue from the contracts with the customers, and not as per the Ind AS 2. Means if you are incurring any cost under the contract with the customers which are not giving rise to the inventories. The standard also prescribes in the scope area that this measurement principle of the standard do not apply to two commodities. One is the producers of agriculture and forest products, agriculture produce after harvesting, and minerals and mineral products. For this, the measurement criteria of this standard is not applicable. These inventories are measured at net realizable value in accordance with the established practice in those industries. And when such inventories are measured at NRV, changes in that NRV are recognized in the profit and loss account in the period of the change. This is the first exception to the measurement. And the second one is commodity broker traders, who measures their inventories at their fair value less cost to sell. And when such inventories are measured at fair value less cost to sell, changes in the fair value should be recognized in the profit and loss account in the period of change. So we have seen the scope. The inventory, the standard applies to all the types of inventories except financial instruments and agriculture produce. And the measurement criteria doesn't apply to the produce of the agriculture and forest products and the commodity broker traders. Now let's move to the definitions. The standard prescribes three most important definitions. One is for the inventory, second is net realizable value, and third is fair value. Let's see, what is inventory? Inventory is an asset that is held for the sale in the ordinary course of business and in the process of the production for sale or in the form of material or supplies to be consumed in the production process. What is NRV? NRV is the estimated selling price in the ordinary course of business less estimated cost of the completion and estimated cost necessary to make the sales. NRV is the net realizable value. What is fair value? Fair value is the price that would be received to sell an assets or paid to transfer a liability in an orderly transaction between the market participants at the measurement date. Friends, net realizable value is an entry specific measurement, means it is specific to the entry. NRV is specific to the entity, but fair value is market based measurement. The difference between NRV and fair value is NRV is entity specific measurement and fair value is market specific measurement. Now, measurement. As all of you know that inventory shall be measured at the lower of cost and the net realizable value. This is a simple concept. But while measuring this inventory, cost of the inventory, what the cost one can include in the inventories, here are the illustrative list that cost of the purchase, net of trade discount, including taxes, transportation and handling. Second one is cost of the conversion, including fixed and variable manufacturing overheads. Only manufacturing overheads are included in the cost of the conversion, meaning thereby administrative, selling and distribution overheads are not to be included in the valuation of the inventories. And other such costs which has been incurred in bringing the inventories to their present locations and the conditions. Now, the question arises whether packing material should be included in the cost of inventory. The answer is obviously yes. Then, whether the primary packing material should be included or secondary packing material should also be included. Let's see what is the difference between the primary and secondary packing material. The primary packing material is one which is essential to bring an item of the inventory to its sellable conditions. For examples, bottles, cans, etc. in case of a food and beverages industry, these are the primary packing materials. But other packing materials like carrots are required for the transporting and forwarding these materials, that would be classified as a secondary packing material, and the cost of this secondary packing materials should not be included in the cost of the inventories. That is, primary packing materials should be included in the cost of the inventory. Let's see which costs are not to be included in the cost of the inventories. While valuing the inventories, which costs are to be excluded? Any normal wastage should be included, but when there is abnormal waste, it should not be included in the cost of the inventories. Storage cost should not be included in the valuation of the inventories unless this storage cost are necessary for the production process. Administrative overheads, as I have told, selling cost is not to be form part of the inventories. Foreign exchange differences, interest cost when inventories are purchased with deferred settlement terms. These are the costs which do not form part of the cost of the inventories. How this cost of the conversion works? Cost of the conversion of the inventory includes cost directly related to the units of production, such as direct labors, manufacturing fixed overheads. They also include systematic allocation of the fixed and variable production overheads. The main point in the production means distribution of this fixed and variable production overheads, this allocation, one needs to keep in mind this allocation should be done on the normal capacity of the production facilities. The allocation of the fixed overhead production overhead to the cost of the conversion is on the normal capacity of the production facility, meaning thereby the amount of the fixed overheads allocated to each unit of the production is not increased if due to low production or ideal plant capacity, that unallocated overheads are recognized as an expense in the period in which they are incurred. Means if you have any unabsorbed fixed overheads, that need to be expensed out in the period in which it is being incurred, and it need not to be added to the cost of the inventories. Now, which are the cost formulas that has been prescribed for the standards? For an item, for an inventory item that are interchangeable, means you can not identify specific inventory item, there is a lot of inventory items, then specific costs are attributable to the specific individual of item of inventory. For items that are interchangeable, means you can change the items. Ind AS 2 allows you to follow either a FIFO method or a weighted average cost formula, but the LIFO is prohibited. The entity should use same cost formula for all the inventories with similar characteristics as to their nature and use. For the group of inventories that have a different characteristics, different cost formula may be justified. Sometimes inventory valued at NRV, in that situation, they become obsolete, damaged, or might be selling price are declined below the cost. In such a situation, sometimes purpose of the use should be taken into account. Means if you are carrying an inventory held for a particular service contract, then such inventory should be valued according to the contract price, means contract price of that contract. You need to figure it out. When this inventory should be recognized as an expense? As soon as inventories are sold and the revenue is recognized, the carrying amount of these inventories is recognized as an expense. Oftenly we call this as a cost of goods sold. Now, if there is any write down of inventory to net realizable value, means you are carrying a inventory at cost which is being written down at the NRV, and any inventory loss, that inventory loss should be recognized as an expense when you are incurring these losses. And vice versa, if any reversal is there, it should be recognized in the income statement in the period in which reversal occurs. What are the disclosure requirements with respect to this inventories? With respect to balance sheet, every item of inventory, the carrying amount should be disclosed. Generally classified this as a merchandise, supplies, materials, work in progress, and finished goods. This classification depends upon the type of the inventory, type of the entity. There might be some more classification or some less classifications. Entity needs to disclose carrying amount of any inventory which has been carried at fair value less cost to sell. Also, entity needs to disclose the carrying amount inventory which is being placed as a security for the liabilities. That need to be this disclosure should be separately made in the notes to accounts. With regards to the profit and loss account, what are the disclosure requirements? Any amount which has been written down of inventory recognized as an expense should be disclosed separately. Any amount of reversal of write down to NRV and the circumstances that leads to such reversal should be disclosed. And the cost of the inventory recognized as an expense means for which sales has been recognized, that should be disclosed. And in the notes to accounts, the entity should disclose accounting policy with respect to which cost formula they are using, what are the cost component they are considering, and how the valuation of this inventory is being carried out. All the accounting policy with regard to this needs to be disclosed in the notes to accounts and significant accounting policies. Now, as I told you in the beginning, that there is a most debate was made on the inventories, how the auditor will be able to verify the inventories at the end of this financial year. There is a general tendency that the auditor will visit for the physical verification of inventory as at 31st March every year. Now, due to post COVID-19, this was not possible at all. But our auditing standard specify the alternative audit procedure that needs to be carried out by the auditors. Let's see, there are 4 or 5 points which needs to be taken into care while doing audit this year due to post-COVID-19 situation with respect to the inventories. First is valuation of inventory needs to be checked. What it needs to be checked? That it might be necessary to write down the inventories to net realizable value due to reduced movement of inventory, or there might be a chances that decline in the selling prices, or inventory obsolescence due to lower than expected sales. Auditor needs to verify all these conditions and accordingly do the valuation of the inventories post COVID-19 situations. Now let's see if the physical inventory counting is conducted at a date other than the date of the financial statement. If auditor is unable to attend the physical inventory count due to unforeseen circumstances, then what needs to be done? If physical count is attended, if physical count is impracticable, then what needs to be done? What audit procedure needs to be followed when inventory is lying in the custody and control of the third party and inventory for the manufacturing organization? All the points are necessary due to this COVID-19 pandemic. Let's see one by one. First one is, if physical inventory counting is conducted at a date other than the date of the financial statements, means you are conducting physical count post lockdown is over, then what audit procedure needs to be followed? You need to perform the audit procedure to obtain audit evidence about whether changes in the inventory between the count date and the date of the financial statements are properly recorded, perform test counts, and what are the considerations when designing this audit procedure? Please consider whether the perpetual inventory records are properly adjusted. The reliability of entities' perpetual inventory records needs to be checked. And if there is any difference, then reason for significant difference between the information obtained during this physical count and perpetual inventory records needs to be checked into account. Friends, all the alternate audit procedure has been prescribed by the SA 501 audit evidence, para A19, A9 to A11. The same auditing standard also prescribes if the auditor is unable to attend or it is impracticable for him to attend the inventory counting, then the auditor needs to perform the alternate audit procedure to obtain sufficient appropriate audit evidence regarding the existence and the condition of these inventories. Auditor needs to make or observe some physical count on alternative dates and perform the audit procedure on intervening transactions and some input-output analysis. For example, inspection of the documents of the subsequent sale means you need to verify the subsequent sale for which specific inventory items are acquired or purchased prior to physical inventory counting is been done. That may provide a sufficient appropriate audit evidence about the existence and the condition of the inventory. As I said, you need to do some analytical procedures also. And if you are performing this alternative audit procedures, if the auditor, as an auditor, if you are not satisfied, in that an extreme cases, the auditor shall modify his opinion in the auditor's report in accordance with the SA 705. Third one is, what if inventory is lying under the custody and control of the third party? Then the SA provides that the auditor shall obtain sufficient appropriate audit evidence regarding the existence and the condition of that inventory by performing one of the following procedure. What the procedure that he needs to follow? Request the confirmation from the third party as to the quantities and condition of these inventories held on behalf of the entity and perform inspection or other audit procedure appropriate in these circumstances. Friends, this is most important part in case of the manufacturing organization. This is partially applicable for financial year 1920, but most probably applicable for the financial year 2021. That is the current financial year. Now, due to this COVID-19 situation, we need to reassess that practices for overhead cost absorption that I have told you in a previous slide also. If the production volumes becomes abnormally low during the year as a result of this plant closures or lower demand of the products, then we need to reassess the practice which has been followed for this systematic allocation of this fixed overhead cost. Allocation of this fixed overhead cost to each unit of production based on the normal capacity of production facility only. If an entity is not able to absorb his fixed overhead cost, it should not be allocated to the inventory, and the cost of carrying amount of the inventory should not be increased. Instead of unallocated fixed overhead costs are recognized in the profit and loss account in the period in which they are incurred. In 2021, in the financial year 2021, entity will mostly face the situation because in the April month there was no production, in the May month also there won't be any much production. Then there might be a case that this fixed overhead costs are not absorbed fully, and this auditor need to verify this unabsorbed fixed overhead cost needs to be charged to the profit and loss account and not to the inventory, by which the carrying out of inventory does not increase. Let's take an example. In view of the significant contraction in the economic activity caused by this COVID-19, an entity expects significant reduction in its sale in the near future. Therefore, it has decided to offer a substantial amount of the discount on its selling price of the product and has made a public announcement also for this. The public announcement was made after 31st March 2020. Now the question is, how should the entity consider this policy of decision while measuring its inventory as of its annual financial reporting date of 31st March 2020? The entity has announced reduction of or discount of this policy post 31st March 20. Now the solution to this problem is writing down inventories below the cost to net realizable value is consistent with the view that the assets should not be carried in excess of the amounts expected to be realized from their sale or use. And the para 34 of the Ind AS 2 provides that the amount of any write down of the inventories to a net realizable value and all losses of the inventories shall be recognized as an expense and disclosed separately in the period the write down or loss occurs. Accordingly, subsequent reduction in the selling price needs to be considered in arriving at the NRV at the balance sheet date, as the condition of the COVID-19 existed at the balance sheet date and which was caused reduction in the selling price, meaning thereby the valuation of the inventory as on 31st March 2020 needs to be carried out at NRV, means the discount which entity has announced should be deducted from the carrying amount of the inventory as on 31st March 2020. Further, also, where the finished goods inventories are expected to be sold below the cost, when the finished goods are expected to sold below the cost, that finished goods are valued at NRV, then the materials and other supplies which is being held for use in the production may also require to be written down to NRV. This is the crux of this case. This is what about the Ind AS 2. Now we will move to the Ind AS 16 regarding property, plant and equipment. We will see the questions at the end of the session together for both the accounting standards. Let's see Ind AS 16. Ind AS 16 deals with the recognition, measurement, depreciation with respect to this property, plant and equipment. Let's see what is an objective of the standard. The objective of this standard is to prescribe the accounting treatment for the property, plant and equipment so that the user of the financial statement can have information about entity's investment in its property, plant and equipment and what are the changes in such an investments. What is the scope of this standard? The scope of this standard is applicable to each class of the property, plant and equipment unless other standard requires or permits a different accounting treatment, and it does not apply to three assets: the property, plant and equipment which has been classified as held for sale. Ind AS 105 will deal with this such a situation. Biological assets held for the agricultural activities for which a separate accounting standard is there, which Ind AS 41, and exploration and evaluation assets and mineral and rights and reserves, which has been dealt with by Ind AS 106. Now, what is the property, plant and equipment? The standard prescribes the definition of the property, plant and equipment is the property, plant and equipment are tangible item. It should be a tangible item that held for use in the production or the supply of goods or services, or it can be for the rental to others, or it can be held for the administrative purposes, and the entity is expected to be used during more than one period. The property, plant and equipment definition specifies that the item should be a tangible item and it should be used in the production of the goods or services. It can be for the rental to others. The item can be for the administrative purpose also, and the benefit or is expected to be used for more than one accounting period. Now, recognition. When this property, plant and equipment satisfy the definition of this standard, it should be recognized. But before recognition, the standard prescribes another two major conditions that needs to be satisfied before this property, plant and equipment needs to be recognized. What is this? The cost of the item of the property, plant and equipment shall be recognized as an assets if and only if these two conditions are satisfied. What is this? First is, it is probable that the future economic benefit associated with the item will flow to the entity, and this cost of the item can be measured reliably. Only if these two conditions are satisfied, then only this item of the property, plant and equipment should be recognized in the balance sheet. The second most important part with respect to the recognition is unit of measurement. The standard does not prescribe the unit of measure for the recognition. What is units of measurement? That is what constitute an item of property, plant and equipment that is not prescribed by the standard, an entity needs to take a judgment and apply this recognition criteria. For example, it may be appropriate to aggregate individually insignificant items such as molds, tools, dies that needs to be aggregated and then apply the criteria to the aggregate value. Means if we aggregate these all the molds, tools and dies, and the aggregate value which we arrived, after that we need to apply this recognition criteria and we need to check this condition. Now the question arises whether the item such as spare parts, or there might be a standby equipments, or there will be a servicing equipments, such items also needs to be recognized as a property, item of the property, plant and equipment only if they meet the recognition criteria. Now, at the initial recognition time, how the measurement is being conducted? At the initial recognition, the entity is allowed to recognize the item of the property, plant and equipment at its cost. Means an item of property, plant and equipment that qualifies for the recognition as an asset shall be measured at its cost only. Standard prescribes two exceptions with respect to the recognition at cost. There are two items which needs to be recognized at the fair value. The first item is if the entity has acquired item of the property, plant and equipment in exchange for a non-monetary assets or a combination of monetary and non-monetary assets, then you need to recognize this acquired item of the property, plant and equipment at the fair value. And the assets which is being acquired in a business combination, that also needs to be carried at fair value. But if in case of exchange transaction, when the exchange transaction lacks the commercial substance and the fair value cannot be determined for the assets which is being acquired in exchange of another assets, then standard prescribes that the acquired asset is measured at the carrying amount the assets which is being transferred. Means if the fair value of both the assets is not reliably measured, the acquired asset is measured at the carrying amount of the assets which is being transferred. Means at the initial recognition stage, item of the PP should be recognized at cost only, except in case of a exchange transaction, the standard allows to be recognized at the fair value. At the initial recognition stage, what treatment needs to be carried out for the spare parts or servicing equipment? The spare parts and the servicing equipments are generally carried as an inventory as per Ind AS 2 and recognized as an expense in the period in which it is consumed. But the major spare parts or standby equipments are accounted as per Index 16, that is property, plant and equipment. But before this recognition, an entity must check for whether the recognition criteria is being met or not. Also, there can be some particular spare parts or equipments that can be used only with an item of the property, plant and equipment, and the recognition criteria is also met, then the same spare parts and equipment needs to be recognized as a property, plant and equipment only. The standard also prescribes the treatment of the major repairs or overhaul expenses which is being to be capitalized if this recognition criteria is being measured or met. Means if there is a major repairs or overhaul expenses are there, then entity needs to check whether the future economic benefit associated with these items will flow to the entity and whether it can be measured reliably. Then this major repairs or overhaul expenses needs to be capitalized to the item of the property, plant and equipment. With the recognition of this major repairs or overhauling expenses, the carrying amount of the previous parts which is being replaced or previous major haul expenses carrying amount needs to be de-recognized as soon as we are recognizing again. Let's take an example. A company has a spare parts which is required to be used along with the equipment. Means this is the spare parts which is required to be used with the equipment only. Whether the spare parts is required to be recognized as a part of that equipment, whether the depreciation is required to be calculated separately for the spare parts, or it can be calculated along with the equipment for which it has been used. And the most important question also arises when this depreciation should start for the spare parts. When it been consumed or when it is being purchased, from which date you are supposed to provide the depreciation on these spare parts. Let's see in solution for this. As per para 8 of the Ind AS 16, property, plant and equipment items such as spare parts are to be recognized in accordance with the Ind AS 16 when they meet the definition of the property, plant and equipment and other recognition criteria are followed. The most important part is depreciation part. The depreciation on such item of the spare parts will begin when the asset is available for the use, that is when it is in the location and condition necessary for it is to be capable of operating and in the manner intended by the management. Meaning thereby in case of a spare parts, it may be readily available for use and it may be depreciated from the date of the purchase of the spare parts and not from the date when it is being consumed. And in determination of the useful life of the spare parts, the entity needs to take into account the life of the machine in respect of which it can be used as one of the determining factor for the same. Means the depreciation of the spare parts begin as soon as you purchase the spare parts and it is readily available for use for the equipment. One needs to be take precaution that it should not depreciate these parts when it consumes. Let's take one more example. Entity A is required to install a new safety equipment in their plant, and these safety equipments is required for the compliance with the safety regulations. If entity does not install this equipment, then the entity is not permitted to run this plant. Whether this cost of the safety equipment be recognized as a property, plant and equipment, we need to test the recognition and measurement criteria. Let's see. But in case of a safety equipment, whether any economic benefit is flowing to the entity? No. But even though the equipment does not directly increase the future economic benefit, but for the entity, it is necessary to obtain the future economic benefits from other assets. If the safety equipment is not installed, the entity is not able to take the future economic benefit from its other property, plant and equipment. Therefore, it is essential to other assets also. Therefore, this safety equipment needs to be recognized as a property, plant and equipment. Now, what element cost that needs to be included in the property, plant and equipment measurement? The cost of the item of the property, plant and equipment should include purchase price less any trade discounts or rebates. It also includes import duties. It also includes non-refundable purchase taxes. The most important part, that it must include initial estimates of the dismantle and removing the item, including site restoration expenses. If criteria with regards to the borrowing cost has been satisfied, then we need to include the borrowing cost and other directly attributable cost, which is necessary to bring the asset to the location and condition necessary to operate. Let's see what this directly attributable cost means. Directly attributable cost to bringing the asset to the location and condition necessary for it being capable of operating in the manner intended by the management. Some of the examples that has been prescribed in the standard are cost of the employee benefits, cost of the preparation of the sites, initial delivery and handling cost, transportation cost, installation and assembly cost, testing cost, and professional fees. Friends, this is just an illustrative list. One needs to consider the test that whether an expense is directly associated with respect to the item of property, plant and equipment for bringing it for its intended use. Let's see an example regarding this directly attributable cost. Entity has purchased a machinery on the 1st January 2020. The machinery is ready to use when it was purchased on 1st January. However, it is entity's intention that entity wants to use it after painting it with a high quality paint. But mind well that painting does not enhance the life of the machinery and does not increase the capacity of the machinery. Then should the cost of the paint be capitalized as the cost of the property, plant and equipment? The answer is no. The cost of this paint cannot be capitalized, as such cost is incurred when a set is already ready for its intended use, and by incurring this cost also that cannot be increased in the life of the machinery. So such an expense is not directly attributable to the cost of the item of property, plant and equipment. Cost which are excluded, which are specifically specified under the standard that this cost should not be included in the cost of the item of the property, plant and equipment. What are these costs? Cost of opening a new facility, cost of the introducing a new product or services, means including the cost of the advertisement and promotional activities, cost of the conducting a business in a new location, administrative and general overheads, initial operating losses, cost of relocating or reorganizing part or all the entities operation, cost incurred when asset is ready for its intended use but not yet brought into operation. These are the specific exclusions which has been provided under the standards. What if asset is being self-constructed? How the initial recognition is being carried out? For the self-constructed assets, the recognition principle are same as acquired assets. It should be measured at cost which has been incurred by the entity for generating these assets. One needs to take into account only 2 points, that which costs are not included: the internal profits, which interdepartmental profits should be excluded from this cost, and also cost of the abnormal amount of wasted material, labor or other resources are not to be form part of this self-generated assets. And if criteria with respect to borrowing cost as prescribed under Ind AS 23 is been satisfied, the entity can consider this borrowing cost into the self-constructed asset cost. What if the payment is being deferred? The entity has been provided with a deferred payment facility beyond the normal credit terms. The cost of an item of the property, plant and equipment is a cash equivalent price only. If the payment is deferred beyond the normal credit terms, the difference between the cash price and the total payment is the interest expense, and the same should be recognized over the period of the credit in the interest expense, unless it's a specific criteria which has been prescribed under Ind AS 23 is being satisfied. It can be capitalized, but otherwise it should be charged to the P&L account as an interest expense over the credit terms, and should not be form part of the cost of the property, plant and equipment. This we have already seen. If the property, plant and equipment is acquired in exchange for another non-monetary assets, or for a combination of monetary and non-monetary assets, then the cost of the acquired assets measured at the fair value, unless the transaction has no commercial substance or the fair value of the assets cannot be measured reliably, then the acquired item is not measured at fair value. Its cost is measured at the carrying amount of the assets which is being given up. Now, asset retirement obligation or dismantling cost. Friends, we have yesterday seen Ind AS 37, in which we have also seen the decommissioning liability. It is same with respect to decommissioning liability. Many entities have an obligation to dismantle, remove and restore the item of the property, plant and equipment. When such obligations are there, the cost of the item of PPE should include the initial estimate of this cost of dismantling and removing the item and restoring the site on which it is being located. And this obligation is generally occurs when it occurs, the item is acquired as a consequences of having used during the operation period. As we have seen, this obligation can be a legal or can be a constructive obligation. Means legal means there is some law which requires the entity to restore the sites, or there may be a constructive obligation from the entity's policy. Then if we identify that such asset retirement obligation exists at the time of the acquisition of the assets, the initial estimates of this cost needs to be incurred in future in fulfilling the obligation needs to be capitalized as a part of the property, plant and equipment, or if asset is leased assets, then as a part of the right to use assets under Ind AS 116. Now, the same way in which Ind AS 37 prescribes that this provisions needs to be discounted at the present value. That means present value of the future cash flow of the cost is discounted at a prevailing market rate of the interest and is capitalized. Let's see one example with respect to this asset retirement obligation. On purchase of the machine, the entity has a legal obligation to restore this site for the prevention of the environmental damages. The entity has estimated that outflow for this legal obligation at the end of the 5th year is INR 5 lakhs rupees. What obligation is at the end of the 5th year, and the discount rate is 10%. Now we need to consider the present value of this 5 lakh discounted at this rate of 10%. Here is the solution for this example. We need to take out the present value of this 5 lakhs at the rate of discounting 10% and needs to find out what would be the initial amount that needs to be capitalized. In this example, it works out to be 3,10,461 rupees, which needs to be capitalized to the item of the property, plant and equipment, meaning thereby at the initial stage of the recognition of the property, plant and equipment, an amount of 3,10,461 debited to the item of the property, plant and equipment, and corresponding credit needs to be made to the provision account. And in the subsequent year, unwinding of the interest will be done and this provision will be increased, which reach to the 5 lakh rupees at the end of the 5th year, and the interest amount will be charged to the profit and loss account at each year. Now, there might be some situation where there can be a change in the initial estimates, initial amount of estimate which the entity has made. There might be a change in the timing. There might be a change in the discounting rates. How this can be accounted? If there is a change in the existing decommissioning, restoration and similar liabilities, the change can be of a 3 types. First and second one will be accounted as revision of estimate. First one is revision of estimates of the outflow, that is amount or the timing may be changed, or second one is revision of the discount rate. If changes pertaining to this first or second, then entity needs to take into account. If entity is following cost model, then entity needs to add or deduct these changes from the cost of the property, plant and equipment and depreciate this property, plant and equipment prospectively over the remaining useful life of the assets. But if entity is following a revaluation model, then this increase or decrease due to the changes in the existing obligation that should be adjusted to the revaluation reserve surplus account and not to the cost of the property, plant and equipment, and entity needs to provide the depreciation prospectively over the remaining useful life of the assets. And if there is a change in the unwinding of the discount due to the passage of the time, the same shall be recognized as a profit and loss account in the profit and loss account as a finance cost as and when it incurs, unless and otherwise specific criteria or conditions are met as per the Ind AS 23. What regards to the subsequent cost? Subsequent cost needs to be capitalized to the property, plant and equipment if the entity is expecting that the future economic benefits are probable from this cost. There are 4 and 5 examples which I have allocated here. The first one is day-to-day servicing cost, including small parts that needs to be expensed out, as it is a day-to-day cost and doesn't increase the future economic benefits. Major inspection, yes, it should be capitalized. Cost of relocating an assets already in use, it should not be capitalized, it should be expensed out. Major modification that enhances the assets output should be capitalized. Expenditure on safety or environmental equipment should be capitalized. Major replacement parts should be capitalized. One thing needs to be kept in mind: while the major inspection or major replacement parts is being carried out, the previous replaced parts or the cost of the previous major inspection which is being carried in the item of the property, plant and equipment must be recognized. Let's see an example of this inspection cost. Simple example: A Limited purchase a machine for the 10 lakhs rupees. On the date of purchase, A Limited assessed that machine would require a major inspection at the end of the every 3 years, amounting to rupees 3 lakhs. This major expense is as a condition for it to operate in a manner intended by the management. Means it is necessary to operate the machine in the for the intended use as intended by the management. Should these expenses will be capitalized? Yes, inspection cost should be capitalized if the inspection is required for the machine to operate in an efficient manner. Hence, inspection of 3 lakhs will be capitalized. Now, what is the subsequent measurement? How subsequent measurement will be carried out? We have seen that at the initial recognition, entity needs to recognize the item of the property, plant and equipment at cost only. But after initial recognition, the standard provides an option to the entity that it can either choose a cost model or revaluation model as their accounting policy and apply that policy to the entire class of the property, plant and equipment. Means entity is not allowed to revalue a particular plant or particular machinery. If the one machinery is being revalued, then entity needs to revalue the entire class of the property, plant and equipment. What is the class of the property, plant and equipment? It is a grouping of the assets of a similar nature and use in an entity's operation. One thing also should be kept in mind: when the entity opts for the revaluation model, the entity should do revaluation with a sufficient regularity. Means every 2 years or 3 years or every year might be, to ensure that there is no gap between the fair value and the carrying value of the assets. Means fair value of the assets and carrying value of the assets needs to be go similarly. What if the entity choose for the revaluation model? If the entity choose for the revaluation model, then revaluation for the particular item can be upward revaluation or it can be downward revaluation. If if the item of property, plant and equipment goes for the upward revaluation, the increase in this revaluation due to this upward revaluation should be recognized in the other comprehensive income and accumulate equity as a revaluation surplus. But if entity has any loss that has been recognized previously due to this item only, then to the extent of such losses, the increase should be provided in the P&L account and balance should go to the OCI account. The reverse will be the case for the downwards revaluation. Downward revaluation should always be debited to the profit and loss account, except if the assets which is being revalued in the past, it has been revalued at upward and there is a charge or there is a revaluation surplus available. To that extent, entity needs to decrease or provide to the OCI account and the balance will be provided to the P&L account. At the end, when the assets is derecognized or depreciated, what this revaluation surplus will be? What is the role? The revaluation surplus is not to be reclassified to profit and loss account, is not to be reclassified to profit and loss account on the disposal, but can be transferred directly to the retained earning. This be directly classified to the retained earning. It is not being routed through the profit and loss account when the asset is derecognized or it is fully depreciated. Now, let's take an example regarding this revaluation loss. A building was purchased on the 1st January 2011 at a cost of 10 crore rupees. It is being depreciated over 50 years on a straight line basis. The company decided to use the revaluation model for valuing the building in 2016 at the subsequent year, and the building was valued at 8 crore rupees by the professional valuers. How the entity would value this building as of 31st March 2016? By 31st March 2016, asset has been depreciated for the 6 years. Hence, the accumulated depreciation comes around to 1 crore 20 lakhs. And due to this accumulated depreciation, the carrying value of this building is 8 crore 80 lakhs at the date of the revaluation. Now, this carrying value of 88 million is compared against the revalued amount of 80 million, and this revaluation loss of 8 million needs to be accounted for under the P&L account unless and until there is a balance which is being lying in the revaluation surplus account, and this balance should be pertaining to this building only. Then and then only you can charge it against this OCI. Otherwise, you need to charge the whole amount to P&L account. Now, can changing of model is permitted? Changing of model is permitted under the standard, but standard puts some restriction on that. Entity can shift from the cost model to revaluation model, but shifting vice versa is not permitted. Means from cost model to revaluation model you can go, but once you have opted for the revaluation model, you cannot go to the cost model. Meaning thereby, once the entity has adopted revaluation model for the one class of the property, plant and equipment, it should follow the same till its derecognition or fully depreciated. Now depreciation. Depreciation is a systematic allocation of the depreciable amounts of an asset over its useful life. Is a systematic allocation of depreciable amount. Now what is depreciable amount? Depreciable amount is a cost of an asset or other amount substituted for cost less residual value. Means cost of the PP less residual value comes to the depreciable amounts, and this depreciable amounts needs to be depreciated over the useful life of the assets. The useful life of the assets can be determined by assets expected utility. Estimation of useful life is a matter of judgment. An entity needs to make a judgment how this useful life is being derived. Factors which needs to be considered while determining the useful life. That is expected usage, expected physical wear and tear, technical or commercial obsolescence are there. There may be some legal or similar limits over the usage of the assets over this period, or there might be some asset management policy of the management that may involve the disposal of assets after a specified time. In that case, the useful life of the assets may be shorter than its economic life. The entity needs to check the residual value and the useful life of the assets at least each end of each financial year, and if expectation differs from the previous estimates, the changes shall be accounted for change in accounting estimates. The change should be accounted as a change in accounting estimates as per the Ind AS 8. For this depreciation part, there is one principle which is called component accounting. For depreciating the assets, the item of the property, plant and equipment, the standard prescribes there might be some component accounting which needs to be carried out. What is the component accounting? That each part of the item of property, plant and equipment, means in property, plant and equipment there could be some parts, means dividing the property, plant and equipment in some parts with the cost that is significant in relation to the total cost of the item, and this item shall be depreciated. Each item shall be depreciated separately. An entity allocates the amount initially recognized in respect of item of property, plant and equipment to its significant parts and the depreciate separately each part. For example, in case of an aircraft, it is appropriate to depreciate separately the airframe and the engine of the aircraft, because both have a different useful life. Airframe has a different useful life, engine has a different useful life. So you need to do a component accounting and you need to account this both separately for the having a different useful life, and you need to provide a depreciation on each such part separately. Let's take an example. Entity A is a shipping company and just acquired a new ship of rupees 20 lakhs. Management has identified various components and proportion of the total fair value of this ships attributable to each component as follow. There is a 3 component which has been prescribed. The estimated useful life of each component is different. The management has worked out the proportion of the total value which has been allocated to each component. There is 50%, 30%, 20%. There is a residual value for the superstructure of 2 lakh rupees, and other for 2 there will be nil for residual value. Now how this depreciation will be calculated? Let's see. First we need to arrive at the attributable cost, that is in proportion to the ratio prescribed, we have arrived at for each component 10 lakh rupees, 6 lakh rupees, and 4 lakh rupees is the attributable cost. From this attributable cost, you need to reduce the residual value to arrive at the depreciable amount. Depreciable amount is the cost less residual value, on this depreciable amounts you need to provide a depreciation that work out to be 90,000 rupees. We have seen the useful life factors which is being affecting to the factors which are affecting to the useful life of the item of the property, plant and equipment. Let's see an example. Entity has purchased a new aircraft with an INR of 1 crore rupees. The entity from which manufacturer it has purchased this aircraft, the manufacturer has guaranteed that the aircraft is designed to operate for 20 years at the projected level of the usage. But entity has a policy of selling this aircraft after 5 years to ensure that it has a very modern fleet. Entity has its own policy for selling it after 5 years. The fair value of this aircraft after 20 years is 1 lakh rupees, and after 5 years it is a 50 lakhs rupees. Means a residual value at the end of the 20 years and at the end of the 5 years. Now, while calculating the depreciation, what useful life should you take into account, whether it is 20 years or whether it is 5 years? As we have seen that asset entity may have an asset management policy, and by that they can prescribe the useful life of the assets which is being used. Here, the assessment policy may involve disposal of the assets after a specific time period, and therefore the useful life may be shorter than the economic life of the aircraft. And therefore, we need to consider the useful life of the aircraft as 5 years, and accordingly we depreciate the aircraft over the 5 years only, and the depreciation works out to be 10 lakhs rupees. Derecognition. The carrying amount of the property, plant and equipment shall be derecognized. When it can be derecognized? On the disposal, or when no future economic benefit are expected from its use or disposal. How the accounting for the gain or loss should be done for over this derecognition? The gain or loss arising from the derecognition of an item of property, plant and equipment shall be included in the profit and loss account when the item is derecognized. What are the disclosure requirements? The entity should disclose for each class of property, plant and equipment what is the measurement base that has been used by the entity, what depreciation methods the entity is being followed, what is the useful life and depreciation rates for this class of property, plant and equipment, what is the gross carrying amount and accumulated depreciation at the beginning and at the end of the period, what is the reconciliation of the carrying amount at the beginning and at the end of the period. Also, this is the statistical disclosure. Other than this statistical disclosure, the entity needs to disclose other things, which are the restriction on the title or the property, plant and equipment pledged as a security. Entity needs to disclose expenditure that has been recognized in the carrying amount of the property, plant and equipment in case of a self-generated, self-constructed assets. Contractual commitment for the acquisition of the property, plant and equipment. In general terms, we call it as capital commitments. Compensation received from the third parties, and if the entity has done a revaluation, then the entity needs to disclose the effective date of the revaluation, the class of the property, plant and equipment which is being revalued, and what is the revaluation surplus they needs to disclose. Now, Let's come to the post-COVID-19 part. Which points needs to be pondered? The main thing that the property, plant and equipment can remain underutilized or not utilized for a certain period of time. But whether the entity should stop the depreciation or during this underutilized or non-utilized period, it may be noted that the standard requires depreciation charge even if the PPE remains ideal. Means if there is no utilization or there might be some underutilization, but the depreciation should continue as it is. Further, COVID-19 may impact the expected useful life and residual value of the property, plant and equipment. The management must review this residual value and the useful life of an asset due to this COVID-19 situation, and if the expectation differs from the previous estimate, it is appropriate to account such changes as an accounting estimates as per Ind AS 8. Friends, this is all from my side. Let's check whether any questions has been received. Seville, you have asked the question, but I am not getting what you are writing. I think you are asking about the normal production capacity with regards to the export to China. If you are not producing anything in the financial year 2021 or in the part of the financial year 1920, the production cost should not be over the normal production capacity. It should be charged to the profit and loss account. Preeti Agrawal has asked, under COVID-19 scenario, how would alternative audit procedure be performed even at alternate date? Preeti, please refer to the standard on auditing 501 audit evidence. In that, there is a detailed description has been provided for this inventory portion, how you can adopt the alternative audit procedures. Please go through with that. Sunit has asked the question whether taxes charged on the inventory which are allowed as a credit as per the tax law shall be considered as a part of the cost of the inventory. No, it cannot be considered as a cost of the inventory when you are allowed to take the credit of the same. One more question is, what if the cost of the PPE cannot be measured reliably? If the cost of the PPE cannot be measured reliably, then how you can account for that? Can you describe the question something more, that whether the asset is available for use or economic benefit are available from this assets? Please describe the same so that I can answer.
Thank you, Manoj ji.
Yes, Virag. I am not visible because
So
still,
we have covered all, na?
yeah, some questions are there, but I am not able to answer because the question is itself
That
not.
we will take in other, in the WhatsApp session.
Just give me the screenshot of this
We'll solve it
question
in
so that
the
I
group.
can answer. Yeah, sure, sure.
Yes, yes. That also will provide.
Yeah.
Bafna ji, please continue.
Okay. Thank you very much, Ms. Manoj Sahu, for an excellent session you have provided on the standard accounting standard, which is you are the master of this standard accounting, and on the inventory and property, plant and equipment in the very correct way in the after this COVID-19. Okay. Thank you very much, Manoj Sahu.
Thank you. Thank you for providing me an opportunity.
Would like to mention that despite of there is power cut in his place, in his location at Baroda, still he has completed an entire session timely and very minutely, answering all the questions and very nicely coverage of entire thing, entire aspect of the presentation.
It's my pleasure. Thank you.
Special thank you, Manoj ji.
Yeah.
Okay.
So we are ending webinar right away here. Thank you all participants. Thank you so much.